Warren Buffett is widely considered the greatest investor of all time. At age 92, he still serves as the CEO and chairman of Berkshire Hathaway. Since taking over the company in 1965, Buffett grew the value of the stock at a compounded annual gain of 20.1%. For comparison, that's nearly double the 10.5% annual total return of the S&P 500 over the same time span. This difference may not seem massive until you realize the power of long-term compounding. To put it into context, every $1,000 invested into Berkshire would have turned into $36.4 million. Every $1,000 invested into the S&P 500 would have turned into $302,000. That difference is immense. So how does Buffett do it? Warren Buffett's greatest advantage is his fundamental understanding of value investing. He knows that stocks are not just prices and charts, but an ownership stake in a real business. Therefore, you need to think like a business owner when investing. Much of Buffett's success has come from investing in companies with sustainable competitive advantages and holding them long term. These are businesses with wide economic moats that generate real cash flow. Buffett then uses the earnings and dividend payments to reinvest and acquire ownership in more productive businesses. This creates a significant compounding effect over time. Although Buffett's company, Berkshire Hathaway, does not pay out dividends, it sure does love receiving them. In 2022, their public stock portfolio is expected to generate over $6 billion in dividend payments. That's $6 billion in 1 year. This is on top of all their operating income from fully owned businesses like the BNSF Railroad, Geico, See's Candy, Nebraska Furniture Mart, etc. In today's video, I'm going to break down all of Warren Buffett's current dividends and explain the massive role they've played in his investing success. Let's roll the intro. My name is Zach, and you should leave a like and subscribe to the channel if you enjoyed the video. Events like the 2022 stock market crash may have you feeling down on investing. Negative sentiment is everywhere you look in the media. However, this is not the time to lose sight of your long-term goals. The reason I'm making this video today is to help refocus our community on some fundamental investing principles. There's no one better to help with that than Warren Buffett. Warren Buffett is what's known as a value investor. This method of investing is where you aim to buy stocks trading for less than their intrinsic value. Seems simple, but there's quite a lot more to it. Even the great Warren Buffett has seen his investing style evolve significantly over time. He went from trading what he called, quote, used cigar butts, to becoming a long-term business owner in quality companies.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, say, in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts, and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money.
This transition to focusing on the quality of the underlying business was largely influenced by his investing partner, Charlie Munger. The importance of quality was best learned through their investment in See's Candies.
But we both kept learning all the time, so that the man we were 5 years earlier was less sensible than the man who ultimately was there. And See's Candy did teach us both a wonderful lesson, and it'll teach you a lesson if I tell you the full story. If See's Candy had asked $100,000 more, Warren and I would have walked. That's how dumb we were at that time.
10,000 more.
And one of the reasons we didn't walk is while we were making this wonderful decision, we weren't going to pay a dime more. Ira Marshall said to us, "You guys are crazy. There's some things you should pay up for. You're underestimating quality." Well, Warren and I, instead of behaving the way they do in a lot of places, we listened to the criticism. We changed our mind. And that is a very good lesson for anyone. The ability to take criticism constructively is well, think of all the money we made from accepting that one criticism. And if you count the indirect effects from what we learned from buying Seas, you can say that Berkshire's been built partly by learning from criticism.
Now I'll tell you exactly why walking away from See's Candy would have been a terrible idea. In 1972, Berkshire Hathaway bought the entire company for $25 million. That year, the business had $31 million in sales and made $2.083 million in profits after taxes. Additionally, the business needed working capital of $8 million to operate. Based on Buffett's valuation of See's, he was unwilling to pay more than the $25 million he offered. That would have proved to be an idiotic decision. As of 2007, See's Candies has earned Berkshire Hathaway $1.35 billion in pre-tax earnings. Additionally, that year, See's sales were $383 million, netting over $82 million in pre-tax profit. So Buffett is well over tripling his initial investment in See's Candy every single year. Based on this, it was totally irrelevant whether they paid $100,000, $1 million, or heck, even $10 million more. It's only gotten better since then. In 2019, Buffett said that See's has produced well north of $2 billion in pre-tax earnings and that the chocolate company remains a cash cow for Berkshire Hathaway. See's Candies exemplifies what Buffett looks for in a business. The company has built a competitive advantage through significant brand and customer loyalty. Buffett has said, quote, "Long-term competitive advantage in a stable industry is what we seek in a business. If that comes with rapid organic growth, great. But even without organic growth, such a business is rewarding. We will simply take the lush earnings out of the business and use them to buy similar businesses elsewhere." This is exactly what he did with See's Candy. The company had limited potential for scaling, but was able to provide a reliable cash flow. This mindset of buying great businesses at fair prices would bleed into all of Buffett's future investments. Now, some of you may be thinking, Zach, what does this have to do with dividend stocks? See's Candies is by principle very much a dividend stock. It's just that the company is fully owned by Berkshire. Virtually all the earnings are paid out to Buffett so he can reinvest in new companies.
See's Candy has paid everything virtually out to us that they've earned because they do not have the ability within See's Candy to use large sums, which they earn, intelligently in their business. So it would be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms. If See's Candy were a standalone company, we would simply pay out a lot of the earnings, practically all of the earnings and dividends, just like we do now, except it goes to Berkshire.
Warren Buffett does not specifically target dividend stocks, yet the majority of his holdings pay dividends. This correlation comes from the types of businesses he targets. Dividend stocks are often highly profitable and mature companies with proven business models. This overlaps heavily with Buffett's investment preferences. As I mentioned earlier, Berkshire Hathaway is on pace to collect $6.07 billion in dividend income over the forward year from its public stock portfolio. Just 5 of those holdings will account for 71% of the total payout. Buffett's largest dividend payer is actually a new addition, Chevron, ticker symbol CVX. In 2022, he purchased 163.53 million shares, giving him 8.4% ownership of the company. Chevron pays a quarterly dividend of $1.42 per share, giving him a forward-looking annual dividend of $5.68. This gives Buffett a total annual dividend income of $900 $128.86 million. I don't know about you, but I wouldn't mind that at all. On top of this, Chevron grows its dividend payment over time and will likely increase it in the coming months. This will increase his future payments even more. Chevron's last dividend increase was 5.97%. It looks like Chevron will soon be Buffett's first $1 billion dividend. As I mentioned earlier, this is a new addition to his portfolio. So what is his cost basis? The bulk of Berkshire's buying activity for Chevron occurred in the first quarter of 2022. Per whalewisdom.com, he has an estimated per share cost basis of $146.56. This puts his dividend yield on cost at 3.88%. In history, Buffett has sold energy stocks after a few years, but he's never owned a stake quite like this. Additionally, he bought another oil and gas stock we will soon discuss. Only time will tell if this ends up being another long-term holding for Berkshire. His second largest dividend payer is Bank of America, ticker symbol BAC. He purchased his position in 2011 at around an average cost of $14 per share. He owns over 1 million shares, giving him 12.9% of the company. Bank of America just increased its quarterly dividend payment by 4.76%, making the forward-looking annual dividend 88 cents per share. Bank of America will be paying Berkshire Hathaway $908.9 million in dividends over the coming year. This puts the dividend yield on cost around 6.28%. Buffett's third largest payer is another new addition, Occidental Petroleum, ticker symbol OXY. He's had a long history with Occidental, but in 2022 he acquired his biggest bet yet. To date, Berkshire has 188.36 million shares, representing 20.2% ownership in the company. Occidental cut its dividend payment in the 2020 oil crash and is slowly increasing it once again. At this low level, the dividend is only expected to pay out $98 million to Berkshire the following year. However, this is bound to grow in the future. On top of this, Berkshire owns $10 billion in preferred stock from his history with the company, paying out another $800 million in preferred dividends. This puts Occidental's annual dividend income at $897.95 million. Fourth on the list is Apple, ticker symbol AAPL. In 2016, Warren Buffett invested heavily into Apple, and Berkshire Hathaway now owns over 5.7% of the company. He's already seen a significant return on his investment, but I think it's poised to be his next great dividend growth stock. This year, he's set to earn $842 million in dividends. His cost basis is estimated to be $34.26 per share, giving him a 2.68% dividend yield on cost. Apple is currently the most valuable brand in the world and has massive customer loyalty. Additionally, it has a huge stock repurchase program and has been increasing its dividend for over 9 years. I would not be surprised at all if in 30 years, Buffett would be doubling his initial investment every 2 years through dividends, similar to his investment in Coca-Cola. Speaking of Coca-Cola, that comes in at number 5 on the list. Buffett has owned the Coca-Cola Company, ticker symbol KO, since 1988. This is one of the best examples of long-term investing and fits the Seize Candies model. This year, that investment will pay him more than $704 million in dividend income. With an initial cost basis of $3.24 per share, Buffett now boasts a 54.2% dividend yield on cost. This means that he is more than doubling his initial investment every 2 years through dividends alone. Coca-Cola has been consistently growing its dividend for over 59 years, and there seems to be no indication this trend will stop anytime soon. This is a classic example of investing in a company with strong competitive advantages and holding long term. These 5 stocks make up over 71% of his $6 billion in forward-looking dividend income. Alongside Coca-Cola, there are many other long-term holdings like American Express and Moody's, which boast fantastic dividend yields on cost. However, this is just his public stock portfolio. Berkshire Hathaway has a massive portfolio of fully owned businesses as well. Buffett takes the cash flow from dividends and fully owned company earnings to reinvest into buying more productive assets. This fuels the compounding machine that is Berkshire Hathaway. When you continually reinvest to increase future earning power, that is a fantastic method for wealth building. This principle of reinvesting earnings is why Berkshire Hathaway as a company does not pay out a dividend itself. However, that is a much larger discussion. I previously made an entire video explaining why Berkshire doesn't pay out a dividend dividend and if they ever will. Of course, there's some great Warren Buffett wisdom in that video, which is linked here. Also, you can check out my entire playlist of Warren Buffett videos if you want to learn more. Investing in dividend stocks and analyzing businesses is what this channel is all about. If you like this content, subscribe and check out my website dividenddata.com. Links in the description and pinned comment.